Hello, ladies and gentlemen. It's Jesse Colombo, Cyber Trading University's Forex and Futures instructor. And today we have a closing bell webinar with John Seville from Acorn Wealth. The topic is going to be the secret sauce of trading. He's going to be teaching us the power of divergence and the difference between absolute and relative analysis. He's also going to be discussing insiders and institutions, who they are and how to know what they are doing, as well as what information is important, how to find it with free online tools. And he'll also discuss the importance of short floats in stocks and their role in the market. So I'm definitely looking forward to that. But until then, I'll be doing my daily market analysis. So right now, you're looking at the S&P 500, my typical starting point. It was a mixed day today. So far, early on, the market rallied, but was unable to hold on to its gains. So it sold off. You can see this candlestick pattern looks like a shooting star as well as a doji. For those of you who took my candlestick workshop, basically that's what happens. There's a long tail here, or long wick as they say, upper wick. And it just shows that the market went up early on and then closed down late in the trading session and pretty much closed exactly where it opened up. So what that shows is indecision. And what's notable is that this indecision is occurring at a key resistance level that I've been showing for quite some time. So you can see if you draw the lines right across, that's a resistance that I've been showing. And it's interesting that you're seeing all these different signs with the candles of indecision and hesitation right over here. We saw it back here. We saw a shooting star, long upper wicks, meaning that the market tried to rally, came back down because it was rejecting that resistance level. And now we're seeing the same thing here. We saw a few days ago, late last week, we saw one of these hanging man patterns, which was also another doji, basically where the market closed exactly where it opened. And then we saw it plunge and then tried to retest that same resistance once again, and it formed another shooting star and doji. So I'm skeptical of what's happening right now unless it can actually close firmly above this level. And I'd like to also see it close above that horizontal line. If you just draw, if you just draw the highs that we saw back in late February. And if it's not able to break these levels to the upside, at least in the shorter term, it's likely to retest this low back here at 2040. So that was an important support level. So it's still in this wedge pattern, which is a trading range. Once it finally breaks out, it'll start running again. But for now, it's just range bound, just waiting for some sort of a catalyst that causes it to run. And that catalyst is most likely going to be some further color on the Fed's upcoming rate hike. And as inflation data comes in, corporate earnings come in, it's another major factor. Other important economic reports come in. It'll help the market finally ascertain when rate hikes, the first rate hike is likely to occur. So there's some indecision right now, and it really has been for the past, not only the past 2-3 months, but also going back all the way to November. Because if you think about it, this entire time, we really haven't advanced much since then. We were just a little over 2070 then. We're at 2098 right now. So really, we've been consolidating for quite some time. Once there's a final breakout, maybe we can run again. So that's what I'm watching for. Let's take a look at the Dow. You can see same thing. This is a shooting star pattern. We saw a similar shooting star right over here. And what's notable about this shooting star on the Dow is that it places the market now, or at least the Dow, right below that 18,000 psychological level. It's an important psychological level that many traders and investors are watching. So, I mean, it in and of itself is not a firm support or resistance, but it's definitely notable, worth watching. But you can see, here's the support at 17,600. If resistance is rejected, it may sell off and try to touch 17,600, but it's still going to be bouncing around for some time until there's further clarity and it finally either breaks out or breaks down. So I'll be watching that closely. is the NASDAQ 100. It fared a little bit better than the Dow and the S&P 500, partly because of news about biotech mergers. And we've been trading quite a few biotech stocks in the cyber group. Biotech's been a very strong sector, but it has been going almost vertical over the last year or so. So many traders are concerned that it's a bubble, and you know what? It probably is. When you have the Fed keeping interest rates at 0% for 7+ years, and we had so much QE, even though it stopped, but we're still seeing the effects of that, it's going to create asset bubbles. They make for phenomenal trading, of course. But, you know, obviously I'm always very skeptical of the effect that it has on the economy when it pops. But in the meantime, it's been driving these markets. You have these underlying bubbles that are driving these markets, kind of like what we saw last decade when the housing boom, housing bubble, we had all sorts of sectors that were tied to housing and consumers and consumer spending, consumer borrowing were doing very well. Those usually lead the market until that bubble pops, usually when the Fed raises interest rates. So right now, this cycle, it's a whole bunch of different bubbles, including biotech. So you can see that's why the NASDAQ performed a little bit better today, but it's still underneath that resistance level. So I want to see how it's going to act here, if it's going to break above or if it's going to try to retest its lows. But I'm not seeing any real confirmation yet. But I'll definitely keep you guys posted when it finally does. Back at the U.S. dollar. Actually, I'm sorry. You know what? Let me backtrack. Let me look at the Nikkei, Japan's stock index. It did make a... Whoops, I'm sorry. It made a pretty significant move last night that I think was interesting. See, I was showing this uptrend channel in Japan's stock index, the Nikkei. It's been following this channel all the way since the start of the year. And it's held. And lots of nice signals were given when it pretty much reached near the top of that channel, as well as the bottom of the channel. So you can see here is a hanging man bearish candlestick pattern, and it pretty much occurred right around 20,000. So it's bumped its head there, pulled right back down to the lows of the channel, and sure enough, it bounced right off there. So it's back at this resistance right around 20,000. So I want to see how that's going to act. But you can see how well it works. It just bounces right off channels. It's really that simple. You don't really need all these very sophisticated indicators. For me, price is the ultimate indicator. I don't need to look at MACD and stochastics and so many other indicators because those are all derivatives of the price. And they're lagging. So why don't I just look right at the pure price and learn how to interpret that? And that's why I'm such a big fan of candlestick analysis, volume analysis, correlation, and intermarket analysis, because those are pure price-based forms of analysis. So here's the U.S. dollar index. It's in that range. You can see the support right over here. It found that support back in late March, and it was also the highs that we saw in late January and February. The resistance is the recent high that we saw on April 12th, as well as March 11th and 12th. So we're not going to know what's happening with commodities and non-U.S. currencies until there's a breakout or breakdown one way or another. It's literally impossible to know in advance which way it's going to break out. That's why I don't predict. I just react. So if there's a breakdown, okay, I'll say, looks like the dollar's about to weaken, commodities about to rise, and non-U.S. currencies are about to rise. If it breaks out to the upside, however, it could cause even more pain in commodities, could cause oil to go back down to its lows or maybe even lower, would punish the euro and non-U.S. currencies. So I'm watching this very closely, but there's really no signal just yet. But the U.S. dollar index is still in a confirmed uptrend. It's been in an uptrend since last summer, and nothing has changed with that, even though a lot of forecasters have been very quick to announce the demise of the U.S. dollar bull market, but I'm not seeing it yet until there's that breakdown. So keep watching that. Same thing in the euro, which just looks like a inverse or flipped version of the U.S. dollar index. You can see it's right under key resistance, right around 1.11 and 1.10. So that's a pretty solid overhead resistance. And it's going to need to clear that in order to reverse its downtrend. And you can see it bounced right off 1.05. So like the U.S. dollar index, it's in a range. It's in a range between 1.1 and 1.05, just bouncing around, bouncing around. When it finally breaks to the downside, to the upside, that'll give us a nice signal. So I'm just going to be watching that, really just kind of sitting on my hands. I want to make it. I really want to start riding these trends very soon, and that's why you have to be very patient. See, around 70% of the time, broad financial markets are not moving. They're actually not moving. They're only moving a minority of the time, about 3/10 of the time they're actually moving. So when you finally see these breakouts, you need to jump on them, because if you miss them, you're going to go back into a consolidation period where they're really going nowhere. This is the British pound US dollar. You can see bouncing around in that range between 1.5 and 1.46. You can see that possibly bearish candlestick pattern. It's a shooting star when it tried to rise above 1.5, was just unable to do it. It rejected 1.5 to the US dollar. So now it's biased to the downside, but I'm watching the US dollar index for cues on that. Let's look at the Canadian dollar, US dollar Canadian. You can see it fell, broke that trading range. And that's because of the oil boom. Basically, oil's rebound caused the Canadian dollar to rebound as well, because the economy is very tied closely to oil. So you can see it's trying to retest 1.24, but I'm not really seeing a real confirmation yet in the Canadian dollar, just because the dollar itself has not truly broken out or broken down yet. But let's take a look at crude oil now. You can see, looks like, it was $54 was the resistance of this range, and $44 was the low, or pretty much the support of this range. So you can see after it rose in last week, it's pulling back a little bit. I want to see if this rally is sustainable, or if it's actually going to try to, maybe if it can possibly go back into its prior trading range. For now, the risk is to the upside, just because it's got that $54 support right underneath. Lori says, I sure like those low gas prices we had. A lot of people did, and you'll notice that even back in February and January, the slightest rebound in oil caused retail gasoline prices to explode, much more than you would expect just based on the price of oil alone. And there's all sorts of other factors when it comes to everyone asks me where retail gasoline price is going. I really don't know, because it's quite far removed from actual crude oil, which is hard to predict on its own. But when you have other factors such as taxes, you have refining margins, refining capacity, you have strikes that occur at refineries, you have seasonal demand. So it's a whole other can of worms when it comes to actual retail gasoline prices. Some people claim it's price gouging that caused them to basically hike their gas prices much more than the underlying price of oil. So many different factors there, of course. But traders don't trade retail gasoline prices. You can trade a contract known as RBOB in the United States, which is a wholesale gasoline futures, but not retail. It doesn't incorporate taxes and other factors like that. So let's look at the dollar yen. You can see the yen weakened a little bit. This is the US dollar yen, so when it goes up, it means that the dollar is strengthening and the yen is weakening. So you can see a little bit of weakness in the yen today, and that's actually what contributed to the Japanese Nikkei stock index's pop last night in their trading session. So I'm just watching this range. I want to see if there's going to be a true breakout above 122, because I am interested in this trade. If it drops, I'm not so interested, because it's not part of my overall thesis. But if it can actually rise above, I'm more interested, because the prior trend was up, and I want to see if this is going to be a continuation pattern, and also because the tendency on the part of Bank of Japan has been to keep on printing money with their QE program, their Abenomics program, to try to stimulate their economy and try to pump liquidity into their financial system to kickstart their economy. But it's just been slow going, and that's why some traders are speculating that there's going to be another phase of the Abenomics program that's going to cause the yen to weaken significantly against the dollar. So if that happens, I really would like to bet against it, because these moves have been phenomenal in the dollar yen in recent years. If you catch a move like this, you can make tens of thousands of dollars, if not hundreds of thousands of dollars, depending on how much you're trading with. But it's not hard if you can actually get in and stay in, and then keep on moving up your stop losses, keep on trailing them up. So that's why I'm looking for the perfect entry point. You really need to nail the entry point just so you don't get shaken out. It's really just like stocks that we trade in Cyber Group. It's the same thing with forex. All right, so let's look. What else? Please let me know any markets you want to discuss. I'm just going through all the major markets, but I'm not limited to these. I can talk about Apple. I can talk about Facebook stock. I can talk about wheat, corn, a lot of different topics. Here's gold. Gold is still in that triangle type of pattern, or this pennant pattern, which we don't know what it's going to be. This could be a head and shoulders if it breaks down, and if there's a bullish trend in the U.S. dollar. Let's say there's a bullish confirmation in the U.S. dollar index, then it increases the probability that gold will drop back down to its lows or its support right around 1150 to 1140. But if the dollar index breaks down from that consolidation I showed, there's a good chance that gold can then finally break out of this right above 1220 and then rally back up to its high. So I'd consider going long futures if in that event. So I'm just a lot of just watching right now in the if you're a macro trader. So just watching and waiting for confirmations. But if you catch them, then you can win big. So 10-year bond international. Oh yeah, billionaire bond king Bill Gross today came out and was saying that shorting the German 10-year bond, that's basically equivalent of their 10-year treasury bond, is a generational trade, because all European bonds have soared, and their interest rates or bond yields have dropped significantly in the past year because of the ECB, or European Central Bank's quantitative easing program. They're printing 60 billion euros per month for the next year and a half or so that they can try to stimulate their economy, and it's basically found its way into bonds. And so this billionaire of PIMCO fame, Bill Gross, is saying short it, which I'm sure he'll be right at some point, but I don't want to bet against central banks. That's what's difficult about it. You're betting against a central bank that's actively printing and buying bonds. But I agree. All bonds around the world, or the majority of bonds, I believe, are overvalued. There's actually a bond bubble, meaning interest rates are at all-time lows in human history. Not the history of the last 50 years, 100 years, 500 years. I'm talking about throughout human history, bond yields have never been this low. It's just remarkable. I've seen the charts where they go back thousands of years and estimate where interest rates would be, and we're at all-time lows. So we're definitely in very unprecedented times. But it certainly makes for wonderful volatility as a trader. One guy won against the BOE. Yeah, that was back in 1992. George Soros basically broke Bank of England, bet against the British pound, and made over $1 billion in, I think, a day or two. Chuck asks, how would I play it? It's very complex, because I have a multi-pronged strategy. One of them involves being very liquid, meaning having a lot of cash, because these are very uncertain times. I do not invest in the stock market. I will literally not invest 1 red cent of my money in this overvalued stock market. However, I will trade it. I'll trade it like a hot potato. You know, that's why I become so interested in also working with cyber trading universities, because I like the idea of intraday trading, because it allows you to not have to take overnight risk, and you can get in and out like a hot potato, and at the end of the day, you go home in full cash. But I also like swing trading. I'll swing trade gold and oil and other longer-term macro themes. And then I also like investing in gold for the long run, because I'm suspicious of all the money printing and fiat currency debasement that these central banks have been doing over the last 7 years. So I do like gold in the longer run. I'm concerned that gold, I'm going to show you a longer term chart though. I am concerned about this pattern in gold. and what this pattern is. I don't know what it is, and I don't think we will know until there's some sort of a breakout or breakdown. But because the prior trend was down and a very sharp downtrend, I want to see if this is a bearish wedge. Because if this is a bearish wedge and gold actually really does break down significantly below 1150, there's a very good chance it's going to go down to 1,000, and if it drops below there, it could go to 800 or even 600. So if I'm going to be investing a significant amount of money, I want to invest it at 1,000 or 800 or 600 instead of right up here at 1,200. And I'm also waiting to see, let's say, maybe if it does break out to the upside, then I'd say, okay, it looks like it's probably going to go higher from here. So I'm watching this. I've been watching this for years, for 2 years, what is happening. But it's very complex, you know. Lori asks, so is bearish pen on the month chart for gold? That is my theory, but I'm waiting for confirmation, because I just don't know. But that's my, let's put it this way, that's my fear. I don't want to buy in something that could be a pennant where there could be a further downside. And what could cause this downside? Well, the Fed is tightening. The Fed is actually looking to raise interest rates. It may not happen, probably not going to happen at the June meeting. Maybe not even September, but probably December. And we know they're going to do it at some point. You know they cut back QE, and we know the Bank of Japan and ECB is printing full force, and they're basically constantly printing, even though the U.S. kind of slowed that down. And there's further upside risk for the dollar, and they trade inversely. Gold trades inversely with the dollar. So if there's further bullish action in the dollar, that could really knock gold down. So I want to get a bargain. So I'm just watching this, and it's kind of been driving me crazy, because I want to get a resolution for this. But I guess it gives more time for me to build up my earnings and to build up my potential buying power when that day comes to make that final gold purchase. Exactly, Lori. I firmly agree. Everything's being done with smoke and mirrors. It's not a real recovery. I mean, when you print trillions and trillions of dollars, and we're basically just bumping along, you know, and that's not an organic recovery. Exactly. Governments taking on tons of debt. State governments, local governments, corporations are binging on debt. They're taking advantage of record low interest rates, and they're using it to buy back their stock. There's been something like $7+ trillion worth of stock buybacks in the last decade, and that's creating upward pressure on stocks. But anyway, it makes for phenomenal trading, though. I'll give you that. So, Hemant says gold will be at 700 in the next 2 years. That is entirely possible if this does break down, if this possible pennant breaks down. So I just watched that. I was watching the lower bounds of this pennant just to really make sure that it's really breaking down, is right around 1150 to 1140. You can see with a couple lows here. So I want to see a real solid close there before I feel confident, because there have been so many head fakes right at this move where it used to be 1200. 1200 used to be the line in the sand. The traders were watching. Every time it would drop below 1,200, they would sell, and all of a sudden gold would go back up and fake them out, and then they'd be stuck with a loss. And now it kept on dropping below. So it really needs to break below 1140 in order to give that solid bearish confirmation. So I'll definitely keep you guys updated when that finally happens. So, all right, I'll be back in 2 minutes. I'm going to introduce John Seville from Acorn Wealth, and I'm looking forward to his closing bell. Let me see. James asks, would we have to see the S&P 500 go sharply higher for gold to drop in a major way? There actually is a very good chance of that scenario, because that's one of the main reasons why gold has fallen out of favor, is because so much capital has been exiting gold. Gold does not earn a dividend. Gold's not an asset that performs well in a, let's say, a typical recovery type of period. So it's very possible. That's why I was saying that basically that consolidation, that wedge consolidation in the S&P 500 I want to see if there's a bullish breakout on that wedge, then that could correspond with some sort of bearish action in gold. So, all right. So I actually want to introduce John Seville right now. So, John comes from Acorn Wealth, and he's going to be discussing the secret sauce of trading. And he's going to be basically discussing the power of divergence and the difference between absolute and relative analysis. He's also going to be discussing insiders and institutions, who they are, and how to know what they are doing, as well as what information is important and how to find it with free online tools, and the importance of short floats for stocks and their role in the market. So I'm really looking forward to this. And thank you so much for coming on, John. And let me just share the slideshow 1 second. So, John, when you're ready, you can begin. 1 second. All right, you can speak when you're ready. I'm just going to be on standby 1 second.
Okay, good to hear you loud and clear.
Excellent, sounds good.
Terrific. Okay, I'll just bring up my slide deck, and thank you for the introduction, mate. I was enjoying listening to your commentary in the lead-up.
Thank you very much. I'm looking forward to your presentation.
Thanks, mate, and thank you for everyone over at Cyber Trading University for having us on. We're very much looking forward to today's presentation because we are in a, as we were just hearing about, we are in a position at the market where there's a lot of uncertainty, and we can see that there's a lot of things going back and forth in a consolidation pattern, including gold and the gold miners, and quite a lot of the time, what we want to look at is where is the smart money going, what is and how do we get an edge on the market when everything seems uncertain. And so that's going to be the topic of today, is looking at how we really get an edge on the market. And you should see my my slide deck coming up here in just a moment. Okay, so hopefully everyone has that up on the screen. Okay, just everyone can let me know that you can see that up there. Okay, perfect. Wonderful. So, yes, the secret sauce is the topic of today, and it's and the secret sauce is going to be something where we explore how we get how we get that edge, how we look for the inefficiencies in the market to start locating powerful setups. Of course, towards the end, we're going to be talking about the live markets, and it's a good opportunity that if you do have any specific stocks you're following or want us to look at, we'll have hopefully have some time towards the end to start applying some of the techniques we talk about today over some of these live market conditions and where we're headed next. Of course, the secret sauce is all about understanding that most exceptional trade results or trades result in detecting an inefficiency in the market or some factor that gives us an extra edge over what the rest of the market sees. 10 years ago, when we started doing a lot of technical trading, I mean, I've been in technical analysis for about 12 years. We started Acorn almost 8 years ago now. And in 2007, when we opened, everyone thought I was nuts, talking about voodoo and what this magical technical analysis stuff was all about. Of course, a lot of people hadn't yet seen the oscillation and volatility that 2008 was about to bring, when all of the fundamentals just got blown out of the water and things were moving in such rapid directions until that we'd never seen before. So when we started talking about technicals, fundamentals were still playing a big role in the market, but these days most people have wised up to the importance of technical analysis and charting, and the role that all this high frequency trading plays. And so as a result, the edge that technical analysis had is still certainly there, but if we're going to want to start having an extra edge over everybody else who's looking at the same technical analysis and the same indicators and the same trend lines, we need to start also incorporating, the special ingredients on top. And so what are the special ingredients? Well, some of the things, or one of the most powerful things, of course, that most traders will look at, or more advanced traders will look at, is divergence. So what we're going to have a look at today is what exactly is divergence and how do we identify it, and what is the most powerful form of divergence that we can look for in the market. The next special ingredient we look at is how the emotions in the market are detected and how the two of these factors play into each other. We're going to look at insiders and institutions. Where do we find that information? What information is relevant and not relevant? And what does it mean? How powerful is it? And then we're also going to look at short floats. So what information is relevant to look at there? Where's the best place to find shorting information? And we're all going to do a live analysis through all of these stages, looking at current data for today's close. So let's start off with divergence. And I'm sure most people here are familiar with divergence. If anyone isn't, feel free to share it in the chat box. But there are many types of divergence. The simple definition of it is, if the words don't add up, it is usually because the truth wasn't included in the equation. So divergence is where one piece of data is telling a different story than another, where we can start to see an inefficiency or where two things are moving away from each other. And in technical analysis, this is most commonly diagnosed in the format of price moving opposite to the direction of a correlating indicator. Now, the most powerful form of divergence I like to look at is money flow. That money flow is one of the most powerful indicators that I use in my trading. And this is where I like to focus. Every time I look at a stock, the very first thing I do is look at the charting pattern. Where is support, where is resistance, and then obviously what type of pattern are we dealing with? What does that dictate is going to happen next? But then the next thing that I'm looking for, and the most important thing I'm looking for from an indicator standpoint, is where is the money flow going? And this ties back into an understanding of smart money. So I'm just going to bring up a chart here, and we'll talk about what this money flow indicator means as we start to analyze what it's showing in the form of divergence. So I'll just clean up all these indicators so we're looking at a very fresh chart. Does anyone know here what money flow actually represents? What it's actually analyzing? Any guesses? Okay. Well, let's just start with a quick definition of what money flow is and why it's important, and then we'll get into the divergence, why the divergence is so powerful, and what we're looking for. So I've always found that in a lot of training that you get, you go buy a book of Stock Market for Dummies, or you go into a lot of different kind of technical studies, and you find that even in my original training, you'll be told, this is a great indicator. This is when this crosses this, buy. When this crosses this, sell. Or you might be told, hey, an ascending triangle is bullish, or a rising wedge is bearish. But quite a lot of the time, we get told what to do or what something is without an understanding of why something is. And that is just as important. It's very important to understand why something works and why something is the way it is, because that will help you be equipped to trade in any market condition, with any type of pattern, even if you don't recognize it. So the why behind money flow, of why it's important, is because it studies what a true uptrend is. Okay, so what's the technical definition of an uptrend? Okay, I'm sure everyone here knows it. You're all part of a great group. So what's the technical definition of an uptrend? Higher highs and higher lows. And you read any book on technical analysis, it'll say the same. But I disagree, because I don't think that that's a big enough or a complete enough description. The definition of an uptrend, yes, we are looking for higher highs and higher lows. But just have a think about it. Would you want to invest in a stock that was making higher highs and higher lows but contracting in range? Because this would be a rising wedge. This would not be an uptrend I'd be interested in, because it's bearish. Likewise, if the stock was making higher highs and higher lows, but the volume was decreasing, that also wouldn't be an ideal uptrend that I'm looking for. And worse still, let's say it was decreasing in volume, but as it went up, it was closing lower and lower in the range. Is that an uptrend you'd be interested in? Not me. So if we were going to really study what a real uptrend is, don't we want to incorporate these other aspects? And in fact, that's exactly what we're doing with a lot of popular indicators. So let's take, for example, I've got a few prepared on the screen. Let's take, for example, stochastics. What does stochastics tell us? They tell us whether the stock is closing, where the stock is closing in relation to its range. In other words, is it closing at the top or the bottom? And how consistently? So stochastics is simply telling us about one of those aspects of a real powerful uptrend or downtrend. What's another popular indicator? Directional movement. What does directional movement tell us? It tells us whether we're closing, whether we're making new highs or new lows, and how consistently. And other indicators such as on-balance volume tell us if this price is increasing with volume or decreasing. But all of a sudden now we've got a screen full of indicators telling us basically one thing: do we have the qualities of a real uptrend or not? And that is essentially what money flow does. So this indicator here on the screen that I had up before of Twig's money flow, similar to Chaikin money flow, is essentially looking at all of those variables in one to say, if we're making a higher highs, if we're closing at the top half of the range, and if the volume is going up along with it, then we have a real uptrend, and therefore the smart money must be involved. And so as you start to look at this stock, okay, there we go. I've just used this as an example. This was one of the stocks we traded recently. Take a look at this, for example. What we can see is that as the stock declined, and as the stock basically went flat and didn't change in price, there was a very sharp increase in the money flow. So in other words, the price was unchanged, but the money flow was going up. So even though price was unchanged, more and more and more smart money was rapidly interested in the stock at this price. And so this is what we're looking for divergence. And so we mentioned earlier that we'd be talking about the difference between absolute analysis and relative analysis. And this is where divergence comes into play. Because a lot of people, when they learn an indicator, will simply be taught, okay, if RSI goes up over 30, buy. Or if the MACD crosses negative, sell. And that's absolute analysis, looking at signals. But relative analysis can be far more valuable when we say, okay, what's the indicator saying relative to what it was saying in the past? And so this is the relative analysis. So in terms of absolute analysis, when money flow crosses zero to the positive, it's a buy. When money flow crosses, because that's showing accumulation. When money flow crosses negative, it's a sell because it's showing distribution. And that's absolute. Relative is where we're not so worried about exactly where the money flow is, but the fact that money flow has not changed, price has not changed, but the money flow has. And that is where we get divergence. This would be divergence to the long side, where we picked up a long from 370 up to 430, I believe it was, about 20% over a week and a half. You can see the opposite if you look at the S&P 500. And if we go to the S&P 500, a lot of these key drops in the market have been predicated by a negative divergence. So the market going higher, but money flow going down. And if you can see that, that's exactly what we've actually been happening since February. So every time the market has approached resistance, such as here, and most recently last week on Thursday, you can see that these were great opportunities for short-term shorts. So short-term quick in and outs on the short side as the market was still poised below that resistance. Now we'll talk about later where we may be going next based on the questions that people have. But this is one of the powerful indicators we use in terms of looking at where market direction has come from. Okay, so that's basically the most powerful indicator I look at for looking at divergence. So again, the most powerful form of divergence for a long is where we're getting price decreasing. However, smart money stays stable and goes up. So you can see here an example, big drops in price, but money flow rallying. And therefore the price is potentially misleading and a rally may ensue. And then of course divergence to the downside, where price increases, however smart money decreases. And that's where we see the price increases, therefore potentially misleading, and a drop may be about to occur. Okay, so this often relates to the emotion in the market, because ultimately the market is the best run, one of the best run businesses there is. In the stock market, if you think about it, 80% of the volume comes from high frequency trading. I'd been actually traveling down in Mexico for the last 3 months and was living down there and trading from there. And I met up with a gentleman from Kansas City, Missouri, who works with one of the big high-frequency trading funds. I was having a chat with him probably only about 2 weeks ago. And they account for 5% of the volume in the U.S. markets. And I was chatting to him about basically how they trade. And all they're looking for is simply chasing inefficiencies in the indexes. And that's a whole other conversation, but they're accounting for 5% of the volume, and it's pure technicals, riding the market up 2 ticks and selling off as soon as there's a 1 tick reversal. Very, very quick, very, very fast stuff. So it's a very well-run business. And the market is all about exploiting inefficiencies. And so we want to try and tag along with where the big money is going. And often when the market has been driven up to the kind of recent highs we've had, just as we were hearing about before, this is a terrible time, in my opinion as well, to be investing in the stock market. But trading it in intraday or 2 to 3 day or even 2 week holds, absolutely, because right now the emotion is at its peak, and then we can get big volatility swings. So when we start to see these tops, however, this is when it's really important to look at where the smart money is going and where these special ingredient plays may be. So to do that, what we can do is we can start looking into looking at the traders behind the smart money on an individual scale. So obviously insiders, institutions are those that should know the stocks the best. You know, they obviously work for the companies, they're on the board of directors, or they're the institutions that have glasses of scotch with the CEO, you know, over a dinner table on a frequent basis, and probably would hopefully know the best type of feeling about where the company is going. Now, how do we find them? Well, the first tool I want to share with you is maybe something that people are fairly familiar with already, and this is just going to bring it up on the screen here. Just one moment. Okay, I've got it up on the screen here now. The website is Finviz, F-I-N-V-I-Z. Has anyone not used Finviz before? Has anyone not used Finviz before? This is a free tool. Now, I'm logged into the elite version because I do have a membership with them, but it's everything basically we do with the program is accessible through the free login. So Finviz, excellent tool. You can explore some of the different heat map things and signals and tickers it can give you. But what I like to use it for is looking at insider information and also screening for fundamental stories. Now, today we're going to focus on the insider part of the program to begin with. So if we go into insider trading, there's three very valuable scans that this will do for us. It'll search for the latest insider trading, the top insider trading in the recent weeks, so the largest quantities or the most notable transactions, and then also the top 10% owners. So in other words, the people that own the largest amounts of their companies, transactions that are coming from that group of people. Okay, so as we start to look at these tools, we can start to get a sense, just as a holistic picture, of where the market's going. So we can actually scan through, and if you consider this, obviously the CEOs of Fortune 500 companies and so forth are the ones that should know the economy best. They're the ones seeing the manufacturing orders. They're the ones with the finger on the pulse of the business and the businesses that they deal with. And so just having a scan through, you can get a sense of whether there is a trend in all the latest action. And what you can see here, perhaps, is you can see there's more of a focus on the sale of stocks here than the buys. So we can then go to top insider trading. Okay, and this is where we start to see the more sizable transactions, the ones that we want to take more note of. And you can start to see that when we look at the more sizable transactions, there's a heavy presence of selling. And this can also be an excellent way to be getting trade ideas. So this is, of course, where your technical analysis skills come into place, where you can start to and actually have a look at if you spot any technically strong patterns where insider selling is occurring, and where you get a strong technical pattern. So you might spot this one, for example, as a potential rising wedge. And we'll go into this in a bit more detail. But this is a way that you can again start to have some ideas, and you'll start to see that, in fact, something I've been noticing today, a lot of the healthcare stocks and long-term care facilities have had a fair degree of insider selling over these last couple of days and weeks. And so you're starting to see a few of those like Anthem and EVHC all have that type of characteristic. Okay, so this is one way to get your information. And of course, we can go into the top insider trading as well. And that's going to show you, again, another similar picture. You can see a lot of big insider ownerships all getting out of stocks. So does that mean the sky is falling? No, not necessarily. But this is a good starting point to see where the money's going as a way to generate trade ideas. But To take this a little further, um, when we start to see a company maybe that we like that's in a bearish or bullish pattern, maybe sometimes we want to get a little bit of a better idea of where the insiders are going on a particular stock. So what I've done here is I've just simply I've just looked at whatever insider transactions are happening. But let's say that we want to scan for stocks that are possibly set up that have had insider trading happening on them. And this is where we can then go into the screener. Okay, so here we go. We're in the screener. And of course, we're in options, in earnings season. So let's say that we wanted to start building out a scan for looking for potential trade ideas, incorporating the idea of insider and institutional trading. And this is where we can go to the screener button, and we can click on all, and we can start to say, okay, well, let's search for stocks that are releasing earnings over the next 5 days. So opportunities that are right in front of us. Okay. Now, I would never hold a stock into earnings ever, because it is obviously you cannot control the risk of the stock. You cannot say I'm only going to lose this much, because it could gap down 30% and there's nothing you can do about that. So looking for earnings plays, I'm only using options. But here is one way to do that. So we're looking for earnings dates in the next 5 days. We're going to go for insider transactions, negative, so we're looking for selling. And then we're going to go for institutional transactions, negative, so we're looking for selling. Okay, and you can see we've got 155 stocks that are reporting earnings in the next 5 days. Okay, we can then make sure that it is optionable. It's down to 136. And we can make sure that the volume is, say, over 500,000. Now that's narrowed it down to 87 companies. Okay, now that's still quite a lot to look through. So how might we refine this scan now to look for higher probability potential setups? One of the things we can do here is start to think about what institutional selling and insider selling can generally mean. Now, for me, if I see an insider selling and institution selling, and what that says to me is that they have figured out what they value a good price to sell the company for would be. And so we have to look at, you have to look at not just the actions of buying or selling, but also the lack of action. So if you don't see any insider selling on a company for, say, 2 years, then that shows you that there's very strong long-term commitments in the potential profitability of the company going forward. If you don't see any buying at all, that shows a lack of acquisition. And certainly if you see selling on speculative companies prior to earnings announcements, that's a big kind of warning sign for me. Reason being, of course, is that you don't necessarily sell the company because you think it's going into the bathtub, into the toilet, but you certainly wouldn't sell your company if it was about to gap up 20%, right? You generally would not sell if you had good knowledge that a company is going to gap up 20%. And that's kind of what I'm interested in. So start to think a little bit more about what kind of factors we would do to identify these obscurities, these inefficiencies where a stock that shouldn't attract selling is. And but one of the tools I like to look for when looking for earnings announcements, one of the kind of secret sauce, so to speak, secret ingredients, is to look at high P to E ratio companies. Because what's a high P to E ratio telling us? If you've got a company that's trading at you know, well, I mean, firstly, we all understand what P/E is, right? It's a price to earnings multiple. So if I have a company that does carpet cleaning, and I make $1 million a year, and someone came along to me and said, well, John, how much do you want for your company? I want to buy it off you. And I said, well, we make $1 million a year, so tell you what, I'll sell the company to you for $100 million. That would be very extreme, wouldn't it? Because then if the business stayed the same, it would take 100 years for that investor to make their money back. Now, that might be a ridiculous price for a carpet cleaning business, but maybe not so ridiculous if my carpet cleaning business owned a patent to some kind of magic spray that as soon as you spray two bursts on the carpet, any stain disappeared immediately. Well, now my business might be worth 100 million. Maybe it's worth 200, 300, 400 million. Who knows? And that's where an earnings multiple comes into play, is when there's a great speculation on the company having something really awesome that's going to create much, much, much more money than it currently is. So with that in mind, wouldn't it be strange if the person who owned that company with such huge profit expectations is unloading all of his stock or her stock? And so that's why looking into this combination of factors with a high P/E ratio, with high average volume, with enough volume and negative transactions, we can shorten the list down to a couple of key candidates. And this is now where we can shortlist this to a basic chart. So we click on basic here, and we can now start eyeballing the company. So we've got ALXN, biotech company, which is P/E ratio of 57, price to share ratio of 60. You can see anything in red is considered to be negative because it's overpriced or a poor P/E ratio or whatever the case might be. And we can see here that we have a earnings date of April 23rd before the market opens. So, for example, here, this could be, we then look at the chart and we see if all of these factors are lined up and we have a strong technical, a strong pattern that confirms the trade. And so right there on ALXN, we also have, just purely looking at this purely technically, we also have we're right at the top of a downward channel. And so this is something where we can then go over into whichever brokerage platform you use. I use Interactive Brokers, but we can even just do this with Yahoo Finance, ALXN. We can go into our, we can look at the options. And of course, we have options that expire this week on ALXN. We can look at our chart. We can look at where's the smart money going. Looks like we have, there's not a strong divergence here. But you can see we're certainly, we have some divergence. We're certainly not reaching, you can see here we went, the price of the stock went higher. It made a new high, but money flow did not. It made a lower high. Again, talking about relative analysis versus absolute analysis, you can see that we made basically almost an equal low over here, but we made a much lower low on the money flow. We've now come to almost a similar high. In fact, the closing price on this day and this day are almost the same, and we still haven't come as high as we were before. So there's a slight divergence. And if we then look at the potential for a gap down, for example, on something like that, and we can kind of look at where that midline brings us to, so somewhere around 177 and possibly lower. And so then we can start looking at if there's any kind of potential shorts using those options. Okay, so this is just an example of how we can start to look at inefficiencies then using something like earnings season. But this is something you can do for anything. You can take the earnings out of it and simply look at stock plays. And by again using that same kind of tactic, looking at the high P/E ratios, and then looking for the short setups in terms of the chart. Now, one of the ones, for example, that occurred recently, and this was actually, if we go to FinViz, was something like NOW, N-O-W. Now, NOW was one that came up last week using the exact same scan that I just showed you. And same exact process, you can see was right at the top of the range. Right at the top of the range. The earnings was on April 16th after market. The P/E ratios and so forth for the P/E ratio was really high, 158. And again, we had that insider and institutional selling confirmed with a short pattern. And that plummeted after market from about $84 to $70. So you pick up some $80 puts on that, and you're looking at about a $10 return on the options, which I think were about $1.40, if I remember correctly. Looking from like $1.40 to say $10 overnight. Again, looking for the inefficiencies where price is looking like it's a very strong chart, but the insiders are weak. Now, so when we find an idea like this, let's move on. When we find an idea like this through, say, FinViz or technical screening, maybe we want to actually look at the information and find out behind these figures, you know, what information is relevant. Like, is this selling important? Is it sizable? And the people selling, you know, what type of track record do they have for acting on this type of information? And that's where we can go into another website that is also free, which I love, and it's called InsiderCow.com. Kind of a strange website name.
Looking below the surface, researching a hunch,
and this is where we can start plugging in these ideas. So when NOW came up as a short opportunity last week, and I was looking at it about an hour before the market close, I found it using FinViz, using the same scan that I just discussed, and then went into the Insider Cow, and now I wanted to see what type of action had happened on the company and how relevant it was. So this now brings up all of the insider transactions on ServiceNow. And what we can see, what we want to see when we say, for example, looking at a short like this, is do we have action at a price that is relevant? Okay, so if the insiders were selling off the company, and the price of the stock, even whether it was a week ago or whether it was 3 months ago, it doesn't matter. If they were selling at $50 and the price now was $30, the information is much less relevant because the inefficiency has already been absorbed by the market. They were selling at a price much higher, perhaps anticipating a much lower price, and they were right. It has now resumed a lower price. So that inefficiency has already happened. So what we want to see is we want to look for where that has not been yet accounted for by the market. And so if we go to NOW, N-O-W, you'll see this very, very interesting chart. Okay, so if we start to look at where this selling was occurring, prices were $82.50, $74, $73, basically $80, and $77 to $80 was where all that volume of selling was happening. So we go back and look at the price, and you can see that's basically where the stock was. It was, as in fact, above that, it was at $84 going into the earnings. Okay. So is the price of the selling relevant? Yes, that's the first thing we want to look at. The date doesn't necessarily need to be recent, but the more recent it is, of course, the better. But more importantly, the closer to the current price it is, the better. So we want recent, and we want it to be close to the price. The third thing we want to see is broad-based selling. So when we look at the action of this, you can actually see that they had selling all the way up to earnings. In fact, their chief revenue officer, David Schneider, is reported to have actually sold $570,000 of the company stock the day of the earnings announcement, right before it announced. Sold $500,000 of stock at $82.50 hours before it plunged to a low of $70.32. That's a pretty odd thing to do, wouldn't you think? When the chief revenue officer sells $500,000 hours before they announce their earnings. So this is very valuable. And you can see here, we get all of these transactions, the 15th, the day before, the 13th, the 7th, the 1st, all of these transactions from 1, 2, 3, 4, 5, 6, 7, well 6. We got 6 different people all selling around the same time, including the president and CEO. So we want to be looking for broad-based selling because we want to try and mitigate the risk that it's simply because of tax loss selling, or that it's maybe their daughter's going for a holiday and needs to raise some money for a new car. Who knows? We want to make sure it's not isolated, but there's a general consensus amongst the insiders. And this is where we definitely got that here on Now, NOW. The other thing we can also do is look at institutional transactions, which are less important because they are not as they're not necessarily always right. We know how poorly institutions can sometimes act, but it's certainly valuable to have a look at. Okay. So another company that was another great example of this type of strategy. Oh, and by the way, before we move on from that, I did want to also point out that not only was it was all this insider selling happening and so forth, but you may also notice one of the points I made earlier about that very strong divergence in the money flow. Look at that. Okay, price was going higher. So what happened from here to here? Price is the same, making higher lows and higher highs, but money flow went from 40% down to the day before to 18%. So basically, it halved on increasing price. That's not a good sign going long for the stock. And that's where the inefficiency was to look for the short. Would have paid off handsomely. Okay, so now let's look at one other factor, which is also looking at individuals' performance. So when you go into a stock, one of the other ones we found using this method was ATRA. Now ATRA was a biotherapeutics company, and this actually this came up on our scan right here on the 17th. Just going to draw a line there. Now, this is how we do. This is how you can do analysis the other way around. This is when a stock came up as a very strong long through technical analysis first. And this is how I find most of my trades. See, there's 4 core patterns that I look for. This is one of them. Does anyone know what pattern this is? What type of pattern we're dealing with here? There's about 100 technical analysis patterns out there in the market. Double tops, head and shoulders, but within double tops you can get Adam and Adam double tops, Adam and Eve double tops, Eve and Eve double tops. They're all different and have different probabilities of success. We rank them from 1 to 100, and we only generally trade the top 10 most profitable patterns. This is one of them, and this is a frying pan, or a fallen angel is our term for it, which then turned into a bump and run formation. So a bump and run formation, one of the most powerful that I like to trade, is where you have a down channel where the stock drops more than 60 degrees to the downside, forms a kind of a spoon or the frying pan, and then breaks up again over the 5-day exponential moving average. So I have a scan that looks for these every single day, and so on the and so we get a list of about 5 to 10 every night that meet this pattern. And on that night, it came up. And so I told you about my process. I looked at what was the pattern. It's a very strong bullish pattern. Okay. Then I looked at the money flow. And look what you see here. You see that the price is unchanged and, in fact, significantly lower than where it was before. But the money flow has gone from, for example, here at negative 20 to a lower price at positive 1. Okay, so this was a home run so far for technical analysis. But this is where you can then go in and again use that same tool. And we went into ATRA. And we saw that there was some sizable transactions from various people leading right up into that where we spotted it on the 17th. So even the day later here on the 18th. So I see a question. Information will be posted as soon as the buy or sell is filed. So this was on the 18th. It was filed on the 18th. Would have appeared on this website right away. So you can see we had heavy insider trading. Now, what you can then do is you can then actually look up the individuals themselves, and you can actually look at any other transactions they've done. And so something valuable you can do is you can research the track record of individual insiders to see how well they generally trade the stocks that they have insider information on. So you can actually go in there and look at their past performance of that individual and the different insider companies they're involved with and how their buying and selling has performed. So when you start to go into this amount of detail, you can really see, hey, if you match this up with the dates on the chart, have they gotten in and out of big positions at very convenient times? Now, who knows why they did it? But if you start to see an insider is making huge returns trading their own stocks, I want to watch for when they next buy or sell. And this was where looking into that type of detail was very valuable from an institutional side here on ATRA. So yes, we saw this insider trading, but what really tweaked my interest was when I looked at the institutions. Now, can anyone tell me what two names really jump out at you when you look at who was buying this stock? Any ideas? The first one is Celgene, which is another biopharmaceutical company buying into this company. So that firstly tweaked my interest, and they're one of the key stocks that make up the healthcare sector, spider sector. The other one is Carlos Slim. Now, I was, of course, in Mexico for the last 3 months and noticed quite quickly that things weren't always what they seem. Every cab driver was trying to charge me $10 for a $3 taxi ride, and you know, like it was an interesting experience. But I've certainly noticed that there is a very large divergence between the people in the know and the wealthy class and those of the poor class. And the people who are in the know generally seem to not necessarily always know what everyone else does, if I can put it that way. And And when I noticed that one of the most wealthiest men in North America, and certainly one of the wealthiest men in Mexico, was loading up on the stock at the same time that this smart money was buying, as well as the insiders and the chart indicating so, this also was a very interesting factor. And when I looked at his individual performance, you actually notice that this is one of the only North American companies that, as an insider, has purchased since 2012 and 2013. So that was very interesting. And as we started to then look at the charts, this was a long for us. We traded this from here at from 19 up to 22, and then we bought it on the pullback again and held it up to, I think it was somewhere around 37. Now we should have held it longer, it just kept on going, but that was an excellent trade. So this is how we use that insider information to really make some, to find some powerful setups. Last but not least, shorts. So the final thing that I find quite valuable is obviously looking at the short floats. So starting to see where the shorts are going. Now, in a market that's bullish at the moment, for example, you have to have a fairly strong conviction to short a company. And generally, those people who short are more educated traders. I read somewhere that only 85% of the market goes long only, and that only 15% of traders or investors go short. So naturally, someone who shorts is a more educated trader, or because everyone can short. Even if you're trading an IRA or an RSP, you can still short. You can buy inverse ETFs. Obviously, you can buy puts, but more relative to inverse ETFs, where those funds will go out there and short for you when you buy stock in their fund, which attributes to a short float in the company. So, looking at short floats just tells you where kind of the more ambitious trader's going, and a short float tells us what percentage of the company is being shorted. So, once again, in FinViz, we can look up this type of information. Okay, so for example, we can go into, we can take the earnings out of it. And take the P/E ratio out of it. And you can look for short floats, float short. Okay, so you can actually go in there and search for stocks that have a fairly heavy short float. Now, I find that there's two powerful ways to use the short float. One is for looking for stocks that are heavily shorted, that are set to that are at resistance. Okay, so for example, DDD, you can see is making a double top. We have negative insider and institutional transactions. We have a high P/E ratio. We have a 36% short float, and we have earnings on April 29th. So this can be a good stock play, or it could be a good potential option play. Okay, so once again, we could look at the insider information, and we could look at the institutional action. But once again, the short float is telling us what percentage of the shares is being shorted or bet against. Okay, so then we can also go in and again look at the insider action. We can see where that action is coming from. So we can see that there's been some insider transactions shorting. Institutionally, we can see it's buying. So there's not a lot of insider trading other than a couple of transactions. But what we can then do is we can go into another website I use. This is another tool I wanted to show you, free online tool. Go to shortsqueeze.com, just punch in the symbol, and we can actually see a breakdown of what's going on. So we can see that 50% of this company's shares are owned by institutions, 5% of it's owned by insiders. So 55% of the stock is held by institutions and insiders, yet 36% of the outstanding shares are being bet against. So if you think about that, that means a very heavy percentage of the stock remaining outside of what's held by institutions and insiders is being bet against. It's not like only 5% of the stock is held by institutions and insiders. It's over half. 36% of the float is being bet against. That's a strong consensus to the downside. Okay, so just for an example, this is one way we can throw up DDD. This is one way to get a trade idea that we can then throw up on our analysis. Okay, now and this is obviously you can go through and have a look at the types of stocks that are coming up in this list. But there we get a list of stocks that are heavily shorted with insider selling. Now, the other methodology I'll show you in terms of doing a scan is actually looking for the opposite. We're actually looking at heavily shorted stocks where there's buying. So this one, we're looking for heavily shorted stocks that are at resistance with insider selling. The other scan is to look for heavily shorted stocks that are approaching support with insider buying. Now, why do you think we'd want to search for heavily shorted stocks with insider buying? Any ideas? Why might we want to look for that? That's right, to look for a short squeeze. Because if a company is being heavily bet against, but as it starts to drop towards some support levels, suddenly the insiders and institutions start to buy, it's because they're saying, hey, we think the stock's coming to where we value it at, where we could get an excellent purchase price. So when you have strong insider buying, you can then go in and look at where they're buying at, what price. Is it relevant? Is it broad-based? And when you start to see heavy short floats approaching key support levels, that's where a rally could be about to happen, where all of a sudden you get incredible short squeezes and the stock starts to go up and everyone's forced to cover. And I've seen stocks rally 50, 60, 70% in the matter of 2 days when some of these levels are hit. And that's where you can start to scan through these types of opportunities and look for if a stock is approaching one of those key support areas. Okay, so something like VVUS, it is possible momentum build happening, could be a short squeeze candidate. Okay, so all of this is about taking advantage of the inefficiencies in the market, looking for kind of contrarian ideas where we use a technical analysis first approach. We always make sure that the chart is telling us it's a buy. But if that is then reinforced with those extra ingredients where we have insider trading and institutional trading and maybe things like the short squeeze, then we can really get some powerful trades. Now, I'll take questions in a moment. I've shown you some of our recent trades, but this has been, so we'll come back to that. But this whole idea of the secret sauce is built off, obviously, how we find these really strong technical patterns. So fundamentals are great. P/E ratios, earnings, things like that, stuff in the news. These are all very strong conditions that we can find trades with. But the problem with fundamentals is that they don't give us timing. they can say, hey, this apple is rotten, but when will it drop? You know, that's, if I can use that analogy. And that's where technicals come into place. So one of the things we put together, and we just released this at the beginning of this year, it's called the Ultimate Trader's Toolbox. It's 5 modules long, and each module builds the technical foundation of what we're looking for these high probability trades. So how do we find, how do we use these types of scans in FinViz to locate stocks? But if we get 10, 15, 20 companies, how do we find the one that's best? And how do we pinpoint the exact entry point? Again, like we were talking, he was talking about earlier, you know, making sure you're getting the right entry point to get, you know, so that you can have the right risk reward on your trade. So module 1 is all about the introduction to getting you started and going through high frequency trading. You know, how do these algorithms trade? Looking at the differences between the different market cycles and types of markets. So it's a great introductory module. It's about 2 hours long. Module 2 is about the foundations of Dow theory and how it applies in technical markets. So very, very important stuff here where we go into the difference between oscillation, consolidation, and momentum. So very important because an oscillating stock compared to a momentum stock is as different almost as a long is to a short. And most people try and trade, I've seen so many people try and trade oscillating stocks, misdiagnose them as momentum stocks, and wonder why the day after they buy them, they're stopped out. It's because they're treating it the wrong way. So setting out very clear guidelines on how we trade oscillation versus momentum and the different ways we treat them. And we go into the smart money checklist of start through finish, exactly what to look for in both of these types of stocks. This is, again, about another 1.5 hours to 2 hours. You can go through these in your own time. You get them straight away. Candlesticks and price action is then the next powerful thing. Again, I'm a big believer in the why. I don't really care whether it's called a spinning top or 3 crows or whatever the case might be. I've forgotten probably 3/4 of the names of candlestick patterns a long time ago because that doesn't make you money, doesn't make me money. What matters to me is what is the chart telling me? Why is a rising wedge bearish versus bullish? Why is an ascending triangle bullish versus bearish? And what does the underlying DNA of these candles tell me? And so this is a really cool thing where we're not going to fill your head with theory. I'm not a theory guy. I'm a practical guy. So each of the modules is very much based around how we build upon the previous one to build an exact trade plan of what we want to buy or sell. Module 4, candlestick patterns. This is where we do get into some of the more powerful patterns, and you'll get some definitions in here. But and this is for some of those people who are probably more orientated around day trading, where we're going to be looking at the multiple time frames and how these candles are built, and again why they're powerful. And the final module is my favorite of all, and this is a course that we will actually be selling standalone. We did a couple of offerings on this course last year for $97 as a standalone. This is, though, on its own a $397 course. The scanning for success module. So just even if this is the only thing you watch, this is really, really awesome because this is where I go into my favorite scans for high probability, some of my favorite scans for high probability patterns. So looking at some of the expanding on what we've just done in FinViz and so forth. So for anyone kind of always wondering, well, you know, how do you locate these high probability patterns? This is where we go into the you know, some of the setups and so forth. So this is the 5th module, and we talk about options during earnings. We talk about short squeezes. But another thing we do is we teach you how to do this all in how to scan for this technically. So in FinViz, we're scanning for fundamentals. In other programs, we're scanning with technicals like Metastock, TradeStation, Think or Swim. incredible charts. All of these programs we're able to scan for, use technical scans, and we'll show you how to do that so that you can follow some of our scans, but we'll also teach you how to create your own as well. So that's the 5 modules. The link to enroll in that is acornwealthcorp.com/wish. Now, all of this will be delivered to you in the immediately via email, and you'll be able to go through those in your own time, and obviously develop your questions and start practicing with the scans, finding potential trades and so forth. And then as we go along further, on the end of the month, on April 29th, we have our live putting the trade together session, where you'll then be able to ask questions. You'll be able to talk about maybe trades you found or setups you've developed and so forth. We'll actually run the scans live on the market and pick trades for the next day, entry and exit points. And for the first 50 people who register, we will also then assign you your own personal coach, so that between now and then, you'll be able to call in and have training sessions with them if you want, to ask questions about your own personal application of the training and strategy. So we obviously have a team of coaches that are available to do that with you. And obviously we have to limit that due to their availability of time. So for the first 50 people, you will have access to your own personal coach leading up to the event on the April 29th. And that support is open from 9 a.m. to 9 p.m. So again, there's a link at the bottom. If you do have any further questions that I haven't already answered, obviously I'll see if there are questions now coming through in the chat box. But that is how you can email us or contact us to either sign up or just for questions that you may have. And I'll just throw it over to the chat box to see if there are any kind of questions that you have here. How long can you expect an oscillating stock to keep oscillating before it breaks out? Let's have a quick look. I'll bring up the charts. It depends on the pattern. So generally speaking, a stock will, like for example, an upward channel will generally revert to the downside, and a downward channel will generally revert to the upside. So, for example, if you look at something like this is just one I was looking at earlier with a student, so you can kind of was it that long ago? Yes. Okay. So this was one we were looking at today. I mean, you can see this was a rising wedge formation. So basically, you've got a contracting range. So this is an oscillating pattern in an upward trend. Now, I find rising wedges are not the easiest oscillating trade to take, because they will generally can break down and start hugging that upward trend line. So I prefer head and shoulders patterns, ascending and descending triangles. But the rule that I generally look for is the rule of 3. And by the way, just by coincidence, we do have a possible head and shoulder pattern right there, and strong divergence on the money flow, which is interesting. So I'll write that down as a watch, and I'll have a look at that later. But so Bud, great example. The rule I use is 3, a rule of 3. So when you look at, I think TCO was one of our recent ones. TCO is something I hold short at the moment, again because it was a see that head and shoulders pattern. So you can see that on a daily basis. If you look at ascending triangles, generally the rule of 3 is what I want to look for. In most oscillation, You want to look at where the resistance line is. So in an ascending triangle like that, and generally you'll get 1, 2, 3 tests, and then after 3 tests the line is broken. Same with the channel. I generally find it's about 1 test, 2 tests, 3 tests, and then that's the break. So simple answer to your question, rule of 3. After 3 touches on support or resistance in either of these 2 types of patterns, reverse as well, that's when I expect the break to occur. Do you provide a stock pick service instead? Yes, we do. What we do is we send out an executive summary almost every day, and sometimes intraday as well. Basically, generally that we highlight our 4 to 5 top trades that I'm taking with my own money, either at that time or for the next day, entry points, exit points, and where my stop loss is set, and the breakdown as well. Could we analyze, and if you just want to email me, email us at info@acornwealthcorp.com, we can, or give us a call, we can give you that. Okay, so let's have a look here at this question here on CAMP. Can we explain why CAMP went up? Well, this is an interesting chart. Let's have a look at CalAmp Corp. Oh, and sorry, yes, I will bring up the, I'll leave the link there on the screen so you can, for anyone interested there. So CAMP, well, you can see that we've got that smart money on this one. Yeah, look at the way that divergence is occurring. You have equal lows on the price of the stock, higher lows on the money flow. We go back. It's the volume, so about mid volume. Okay. Let's actually go through looking at this pattern. And this is one of the things we do in the Ultimate Traders Toolbox, is we really want to make sure that we are we're talking about high probability patterns. It makes a big difference to make sure you're in high probability patterns versus low probability patterns. Okay, so we've got CAMP, higher money flow. We could look at the, so that's telling us that we should be possibly detecting smart money. We can look at, we can go to our insiders. Okay, so we've got ALXN. We go, so CAMP. Some slight insider, no real insider activity, small transactions, isolated, so nothing really occurring there. Nothing on the institutions. This would be purely a technical play, and you can see the money flow pushing through. If it's gapped up $2, then I would assume that from 1668 we're about 1868, so we're right into resistance. So where it's gapped up to, if it's up $2, is exactly where resistance would be, and you possibly may have a day trade short there, depending on what that was based off of, other than technicals. Some of the ones that people may be interested in at the moment, some of it, like for example, some of our recent trades, you can see PLX. For those of you who like to play some of the biopharmaceuticals, you've got a strong bull flag here on PLX. In the recent breakdown in the market, it went nowhere. It just held support. That's something we hold at the moment in our portfolio, looking for a nice pop up towards 220. You can see so this, these are some of the key things that we look for. In terms of track record, Sydney, we're looking for, you know, depending on the type of market, if we've got strong markets like volatile markets such as October 2008, or some of these kind of, you know, that was our best month ever. I think in 2008 we had 220 stocks that came up in our momentum scanner, and of those we had close to 75% of them had performed, hit their entry criteria and performed, and that was looking for moves between 8 to 14% over a 2-week period. If you're interested in having a look at some of our recent trades, again, we actually record a YouTube every day with our picks, and we can certainly send you the list of our recent links into those videos showing you some of the stocks we picked. We've had some really excellent success. ATRA was just one of them. ORML, I believe, was the other one, if I'm remembering it correctly. Same type of thing. One of the strategies that's working really well at the moment is flags, flag formations. So that's one of the key things that we've been focusing on, and where a lot of the money that we've been making has came from was that formation. This is the way it was ORMP, flag formation play. And we picked this back here as an entry around $6. Our target was, I can't remember exactly, I think it was 873. And we traded that and sold it right near the peak. So that's these are the types of things, very high probability patterns. Frying pans are one of the top patterns, and flags are one of the highest ranking patterns as well. Very, 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 very good, especially if you trade options, because you get a 50% move or profit like we did on this. This was one I was in myself. We traded it out at a 50% profit within a couple days. Bought it on Thursday, sold it on Monday at a 50% profit. You know, if you pick up a couple of speculative options on things like that, if it's available, this is kind of where you can have low risk, high returns if the flag actually pans out. If it doesn't, it may expire worthless. If it does, you know, these are some of the more exciting speculative plays. And then I'll leave you. It doesn't look like we have too many more questions, so we'll tie things up in a second. If there's anything left, please put it up on the screen now. You know, some of the stocks we're looking at on the short side, things like these breakdown plays like CHD. Again, look at the oscillation: 1 touch, 2 touch, 3 touches. There's the break. So you can see the money flow going right out of it. Goldman Sachs downgraded these to being a neutral from a hold, I believe it was, because they said that basically the company's value is fully appreciated now. And this is kind of where you can get a really short-term option play or a day trade on the drop. You look at the QQQs. I mean, basically, this is one thing to be very applies to the entire market. The QQQs look bullish because we're in a downward channel, and we've had 1 touch, 2 touch, 3 touches on the top, and this is basically exactly how I drew it in paint before, and we're now testing that resistance. So the money flow has been divergent, but we're at a very important test point to break out. One of the most important things you can look at here is the fact that the S&P 500 is forming a triple top as well on divergent money flow. And the key thing you want to look for, most important thing I can possibly tell you from today in terms of the Qs and the S&P, is the open range of Friday. Options expired on Friday. The high was 2102.58. The low was 2072.37. We have not closed above or below that range yet. And it's very important in terms of dictating the market's direction. There's 2 days in the month where it applies, the first trading day and the third Friday. The first trading day of April, the low was 2048, the high was 2067, and we closed above that range. And therefore, we went long until options expiration. The market did go long till options expiration. Now we have the next test point, the next range, and whether we close higher or lower than this range should tell us a lot about the rest of the month of April. So right now we're testing that triple top, and until we close one direction or the other, we don't really know. But so far, the Dow Jones Global Index has done the same thing. It had a triple top, but it broke out and has held above. So my bias would be to the long side, but I think we're going to be coming towards the top sometime soon. I think the 1st of May would be the where we'll get a really next big test. So I think we've finished all the questions. We've certainly got. I've really been enjoying talking to the group. We've obviously got a lot of educated traders here, and this toolbox is all about designing how to add the strong parenthesis of the scanning and the technicals to what you're doing. So you should certainly get a lot of value out of that, especially the people working with our one-on-one coaches as well for questions and application. The link again is acornwealthcorp.com/wish. So if you do have any questions at all, you can give us a call or shoot us an email, and we'll be here for about another 4 hours for anything you have, anything for us. I'll just throw that back, and again, thank you so much to everybody at Cyber Trading University for organising this great event, and we certainly look forward to hopefully seeing you all in our executive toolbox at the end.